Hey everyone, hope we're all doing well. Welcome back to the Learn to Trade series. Now, this week, I actually put a poll out into the Learning Lounge and just asked some of the members in there to vote on the topic they would most like to see next. So we had a few options in there, but the one that just honestly had the most votes by far was confirming an entry in the market, or entry confirmation, however you want to coin that. It seems like the one thing a lot of people struggle with is, yes, they will understand the strategy, they will put in time to learn the ins and outs of that strategy, how to analyze the markets day to day. Then when it comes to actually confirming an entry in the market, that is where people struggle, because I feel like that is sort of the last, or one of the last hurdles you're going to reach within learning is, okay, price has done exactly what I want it to do, but how do I know to give myself the highest probability that price will do what I want moving forward from this point? So obviously for me, as a smart money trader or institutional trader, whatever you want to call it, I'm obviously looking at a certain thing. So let's say we have a trending market like so. I'm going to understand that in this region, I have a buy to sell candle. That is going to be a supply zone to me, because no price action has returned us to that region, and therefore the smart money operators haven't been able to close out on the positions that they would have opened all the way at the bottom here to cause that move up in the market. So my understanding is that eventually price is going to want to start displacing us to the upside and slowly trade us up into this region. But when it does so, how do we know that an entry is confirmed in the market? And when price does tap into that, how do we ensure that when we're getting in on an entry, we still have our edge, we still are working alongside the probability, or a higher probability, the price is going to reverse than it is to blow through it? So as I mentioned, there is going to be a 1-2-3 strategy, or a 1-2-3 approach. This is something I have touched on in one of the recent TikToks on the LAGFX channel. If you're not actually following us on TikTok, make sure you get over there, because we do have regular updates, regular videos. And
How to demand zones could give us plus 95 RR.
honestly, some of the topics covered on there, although they're covered in a quick 30 seconds, 1 minute, it is very valuable information. So I definitely recommend you get over there. For now, let's just think. In our eyes, when price trades up into a point of interest, whether you are trading like me, an institutional approach, or anything else, there needs to be certain things you see in order to confirm the fact that price is reversing, because majority of the time I'm getting involved in the market, it's done so on a reversal. And I believe that 90% of all strategies are done so by getting involved on a reversal, whether that be the tap of support, resistance, supply, demand, a trend line, whatever that may be. We're always going to be looking at the reversal, because we're always looking at retests or times in the market after price has finished a correctional wave for us to then get involved in the next impulsive one. So that is exactly what's happening here. But for us to understand that, right, if the institutions, obviously in this move higher, or the wider scheme correctional wave that we're seeing, we understand that there's going to have to be a lot of demand present. And throughout this entire region, we understand that the smart money operators, the institutions, are opening or have opened large buy positions in the market at these swing lows where they are profiting from buys. But what that means is, because they have these positions open, there's going to be a certain amount of demand that is outweighing that current level of supply in the market. So the first thing that we want to see, so number one, is going to be, has liquidity been created around that zone? So if we're looking to get involved in a sell, or we're looking to enter a position from a supply zone, we want liquidity to be built either just below or within that zone. If we are, however, on the flip side and we are looking at demand zones, we are wanting to see price build liquidity just above or within that zone. So right here, from the example that I've drawn out, the first thing that we can see is that price has this region here where it has created a lot of liquidity. We've had a lot of taps from this region. What that is telling me is that, A, as we know from Wyckoff conceptualizations, which if you would like more in depth on Wyckoff and what this is telling us from a Wyckoff and a Wyckoff schematic point of view, I can do another video on that and go more in depth. But for now, we're just going to stick to the basics of 1, 2, 3. So liquidity, we know that what's happening here is that we, or the institutions, are trying to absorb the demand that is obviously present from this move higher. Now within that, they're also trying to manipulate people out of the market to also introduce supply. So the idea being that, let's say we have one of these sort of old school balancing scales. Now you're going to have to forgive the awful drawing that we will see here. But nonetheless, you should understand exactly what I mean. So what we're seeing is pretty much right here, they're balanced. So let's say we have 50% supply and 50% demand. So when they're like this is an equilibrium. And when we would have an equilibrium, which we pretty much never have in the market, because an equilibrium would mean that the market would be still and it would not move anywhere. But as you say, the more supply that gets entered into the market, the more this drops, the more it tilts into this one's favor, the more weight we have in supply. So what's happening is that in this move higher, we understand that what's probably happening is that demand is much lower down. So if we draw this again, what it's probably looking like is that demand is all the way down here and supply is all the way up here. What's happening is that demand is fully outweighing supply, and therefore the market is moving upwards. There's evidence that we still have a little bit of supply left in the market because we are able to create these small correctional waves. But because the correctional waves aren't deep at all, it's good evidence that there isn't too much supply. Now, as we enter this region, and in this region of building liquidity, what's happening is we're absorbing some of that supply and entering some of that demand. So we're slowly taking away from demand and introducing supply. So this shift is slowly, or we would slowly see demand rising up ever so slightly until eventually it gets to a point where we're reaching an equilibrium. And that's what's happening when we're sort of consolidating in this region. We're somewhere within an equilibrium. It keeps shifting ever so slightly into one's favor back and forth. What's happening is overall we are in some form of an equilibrium. So number one, liquidity has been built, and that is showing us that the smart money operators, the institutions, are beginning to absorb demand in the market. If this was on the flip side and we were looking at a demand zone, they are beginning to absorb supply. Now the second thing that we want to see, so number two, is we need to see high volume move clearing that liquidity. Now the reason it has to be a high volume move is because we understand that when we see volatility, when we see volume, when we see large spread, large volume candles, that is a great indication, not the only indication, but a great indication that the institutions are present and that they have executed a position in that region. So what's happened here is right at this point, the institutions have opened a buy position, and a very large one at that, which has come to clear through that level of liquidity, done so with a very high volume candle. So what we're seeing is likely going to be very minimal wick and a very long candle. In this case, that would be a very long minimal wick buy candle. And the reason we want to see this, as I said, is because it shows that the institutions are present, and when they're present, it means that it's a good indication the reversal's coming, because they're typically getting involved heavily at large swing points, because as we know already, prices played out, but at this point we've had the high volume. The reason they do that is because right at that high point, and the reason they push price through is because at this level, this is where they can then get to execute a large sell position in the market, which should then push price down in the opposite direction and also allow them to profit from sales. So what's typically going to be seen is after we've had that manipulation, price is going to take off with high downside volatility. It's because they've opened such a large position here that we've suddenly shifted the supply and demand balance and tilt heavily into supply's favor, and therefore we're going to have a large move down. Now, the last and final thing we need to see to confirm an entry, and number three, is we need to see a change of character, displacement, whatever you may call that. So what this is that the previous protected low in the market in terms of sells, or the previous protected high in terms of buys, needs to be broken. Now that is an indication that we are getting ready to start running the liquidity in the opposite direction. So in this case, we understand that this was the low that created that high, and the second that because we understand that this has been a high volume candle, when this low gets broken, that means that they have closed out on that buy position. If they're closing out on that buy position, it's an indication that they're no longer wanting to profit from buys. If they're no longer wanting to profit from buys, they're obviously going to want to do the flip side and profit from sells. So this level right here, where we have broken structure, displaced, change of character, whatever you want to call it, whatever you see it as, That is our third thing that we need to see. Now from here, we can either decide to get involved instantly after the change of character has happened with a stop loss potentially above that high in the market, and then our take profit potentially down all the way at this low, if not an even higher time frame low. So that is going to be a slightly unrefined entry, which, as you can see in this example, is a 2.7. Obviously, within the live market, it's going to vary vastly trade to trade. But what we can do is, if we want to actually try and refine that entry slightly more, we can see that what's happened here is that, or what should happen, given that I drew this correctly, is that once we've had that change of character, displacement, break of structure, we'd then try and identify a fractal supply zone, wait for some form of retracement. Now let's just imagine the price does tap into that. That is just my fault for not drawing that correctly, but we've had that displacement. Now this buy to sell is the move that caused that break of structure or displacement, and therefore we're taking that as a supply zone, and then we see price tap in, and then what we can do is we can either get involved straight away on the tap, or we can decide to look for the 1, 2, 3 confirmation once again, where we go to an even lower time frame when price taps in, look for liquidity to be built up, high volume clearance, and then the second we have that change of character and confirmation of the reversal, we'd instantly get involved. And that would allow us, as you will see, to refine that zone. And rather than us having it at the top of this region, we understand that like this, let's say we got involved on the change of character within that, we would just have the stop loss above that high. And then course, that take profit all the way down here, and we've instantly refined that to what, or from what was a 3 to 1 to a 24 to 1. So that is usually the better option, is to refine the position. However, it can be quite harder to find entries, because not always after the change of character, displacement, break structure are we going to see price traders back up and give us a nice full mitigation of a supply zone, because as we stated at this point that we highlighted, the institutions have executed such a large sell position that there's so much supply in the market. It's going to be hard for the market to have these retracements into zones. So it's going to require a lot of patience, a lot of analysis and understanding of how we are looking to refine that entry. But if we are knowledgeable enough and able enough to do so, then obviously you see that the profit returns are much, much larger. So that's the point there. I feel like that covers the concept quite nicely. Just always remember 1, 2, 3 whenever you're looking to enter in on a market. And the reason I'm coining it 1, 2, 3 is because I feel like the most important thing when it comes to anyone with any strategy entering in on any trade in the market is the fact that you have some form of checklist, whether it be similar to mine, whether it be the same as mine, or something you have created yourself. Firstly, figure out whether that checklist has an edge. Make sure that more often than not it is right than it is wrong, and if that is the case, then stick to that checklist, stick to those parameters every time it comes to entering a trade, because it gives you that accountability and it makes sure that you are following your set probability that you know makes you profitable longer term. So that right there is confirming an entry in the market the smart money way, or the way that I look to do it. Now I'm going to take a very quick approach to actually looking at the live markets and giving an example. So one example we can give is, we can see right here off the top of my head, we have a nice buy to sell in the market. The price is tapped. Where does it first tap it? Right at this region. Let's quickly dive into that and see if we can see exactly what's happened. So let's go to 2 hour. I feel like that's probably going to be the best time frame for us to view that on. Make sure we get the full area of that buy to sell. And once again, what we can see in this region is that we have liquidity built up. So all of this region to us is acting as liquidity. And we see that what's happened here is that we've had 1, 2, 3, 4, many taps into this region of liquidity. And what happens is we're showing signs that we're having that next tap where we send price traders into that region, reverse, high volume push down, which is going to mislead people into thinking we're having another tap from some form of support or resistance level. And therefore people are getting involved in sells. Straight after that, we see that from this wick all the way up to this wick, we've had a very heavy high volume push, evident by this high volume candle in itself. And the fact that we're seeing wicks here means that what's happened is we've had that heavy push down, but from that low point, because we've wicked in this region, we've had such a sharp push up. So from this region, we've seen such a sharp push up, push back down, and that's indications for us of institutional control. So what we've probably seen, if we go to a lower time frame, going to have to scroll all the way back, but we can see inside of this that what's happened up here is that on a lower time frame, we would have seen some form of displacement change of character within the fractal structure there, and maybe we could have got involved in the tap of this last buy to sell candle as our entry for 1. And the reason that is valid because we would be following fractal structure and understanding that what's happened here is that we've tapped that supply zone. Now that we've tapped it, we have mitigated it. We've seen some fractal reversals, and therefore we're trying to get involved on supply zone taps. Now, of course, we're doing so much more on the fractal structure, so that is one potential entry we could have there. But if we were to look on a slightly higher time frame scheme of things, we can see that what's happened is arguably this is our protected low here. And after we've had that protected low, that's then where we're looking for supply zones to then get entries from. So we see we have a large buy to sell region there, which could act as a supply zone. If not, we even have this region down here where we have a buy to sell. In that region, this one probably looks nicer than the other because once again, what we do like to see, we've had liquidity built in this region, a high volume push through to clear said liquidity. Number 3, we then had the break of a protected low, change of character, displacement, whatever that may be. After we've had that break, we see that price then trades back up into a buy to sell candle, which is where we could have gotten involved from that tap in itself. Let's say, again, we wanted to refine that entry even more, or we wanted to wait for more confluence. If we went to an even lower time frame, we can see that again, we've been delivered the exact same thing. Liquidity, high volume push through, displacement. Of course, this time round, we didn't get a nice mitigation to come back to that level, but we could have gotten involved straight away after the displacement. We could have seen something on a lower time frame in this region. So let's say we go to here. If it lets me replay, and let's go to a 3-minute. Same thing we've seen again here. Liquidity been built in this region, a high volume push through. The second we had that displacement, we could have gotten involved in an entry. So this is literally happening all the time. And now that you've learned this concept, you're probably going to see it everywhere in the market. But just remember that checklist: 1, 2, 3, liquidity, high volume move to clear liquidity, change of character to the downside. And I promise you, following that checklist or any checklist you come up with in yourself is going to help you be profitable longer term, help you be profitable massively, because we're just being strict on ourselves and we're making sure that we have an edge on our side. So if you have any questions about that, or you'd like more information on any of that, or like I said, how this is relevant to Wyckoff and Wyckoff schematics, I can make a video on that. But nonetheless, I hope you have enjoyed this. Please leave me some feedback in the comments, or if you enjoyed, leave a like. Thank you for watching, and we'll see you next time in another Learn to Trade video.